When we talk about liquidity ratios, that's all about the short term. Debt ratios are all about the longer term. So where a liquidity ratio, like the current ratio or the quick ratio, is looking at current assets and liabilities, debt ratios are looking at more things of the overall or total picture than things like total liabilities and how they're able to service that. And one of the most popular in terms of debt ratios is the debt to equity ratio. In fact, things you have out there like PE or price earnings ratio that's used a lot. I think that one that's used also a lot from a lot of people is debt to equity ratio, because you're trying to see how much debt is out there and can the company service that debt, that long-term debt, and how does that compare to equity, which we're equity owners, we're owners of shares, and thus that's equity. So let's take a look at the debt to equity ratio, real common ratio that you'll be probably using quite a bit. First off, this is all coming off the balance sheet, like those liquidity ratios, and you're looking at the debt in comparison to the equity. So you're taking your total liabilities right off the balance sheet. What is the total? Not current. Now you're looking at total liabilities, and you're dividing that by the total shareholder equity. That's you and I as shareholders. How much shareholder equity do we have there? And we're comparing basically the debt versus the equity, because companies need money to expand and grow. A lot of that's coming from current income. That's where we want to grow, is from earnings per share. We want income coming in so they can then invest in the company, or maybe invest in us by giving us a dividend payout. So income is great. But this, we're looking at how much of our company is being serviced by debt, money we're borrowing, versus shareholder investment. And if there's a lot of debt, well, that's maybe not necessarily a good thing at all. And it measures that relationship between the amount of capital that's been borrowed, the debt, versus the amount of capital that's being contributed by owners or share owners like ourselves. We're comparing that debt to equity is what we're doing. And as that ratio increases, so as you have a bigger debt to equity ratio, the stock actually becomes more risky, because they might have trouble meeting that debt obligation or servicing that debt. If you can't pay your debts, well, what happens? You go into bankruptcy, right? That's a terrible thing. Or you got to continue to borrow more debt to service your current debt that's coming due, and it's this bad downward spiral. And you can sometimes see companies that they think they'll turn around, they say, yeah, we just another quarter, another year, we'll be fine. We're carrying a lot of debt. Don't worry. We got this new product in the pipeline. It'll be great. But meanwhile, they're piling up lots of debt. And if you see companies in comparison to their industry, where you want to compare once again, that are, or even the broader market in this case, that have these real high debt ratios, that should be concerning. So look for companies, when you're comparing them, that have low debt ratios is a good thing. Now, all companies, well, not all companies, many companies carry debt. That's okay, because they're borrowing money. They're going to invest that debt in equipment or factories, or maybe buy another company, a merger or acquisition, and looking at your ROE or return on equity, maybe they're going to take that debt and things will be great, because they're using this debt, and it's going to be they're going to make more on their debt than that they're paying out as far as interest on that debt, and overall paying the debt back is the idea. But that's like a smaller part. You don't want it to be a big number, especially in comparison. So overall, when you're looking at debt to equity ratios, bigger is not better in this case, bigger is better. So lower debt to equity ratios, or even no debt, is a much better thing to look at. But don't be surprised. Most companies have some debt. Some debt is okay. Some debt is good, actually, to help fuel growth. But just watch out for those big companies, or those companies with a big debt to equity big debt to equity ratio, because that could be really concerning.